Hi, I'm Leena Rao here at the TechCrunch TV studio for our Ask a Bee series. We're joined today by Ajay Agarwal, Managing Director of Bain Capital Ventures. Welcome, Ajay.
Thanks, Leena. Great to be here.
Yeah, so before we get started, I just want to sort of clarify. You recently came here, I guess, in the past few years to head up Bain Capital Ventures Palo Alto office.
Exactly.
And you guys moved over here to do some more early stage investing. I want to first start out with a lot of our readers sent in questions about what is the relationship between Bain Capital and Bain Capital Ventures?
Great question. So the way to think about Bain Capital is, we are an investment firm with a set of individual funds. So we have a set of private equity funds. We have a hedge fund. We have a series of debt funds. We have a macro fund, and we have a venture fund. Each of those funds is managed autonomously. So in our venture fund, we have a set of partners. We raise money from limited partners, similar limited partners that any firm on Sand Hill Road may raise from, endowments and foundations. And then the partners of the venture fund, make the ultimate investment decisions. Should we invest in this company or in that company? The benefit we have of being part of the larger Bain Capital is it gives us, and by extension then our entrepreneurs and startups, access to an enormous network and a set of relationships, particularly Fortune 500, Global 500 relationships.
So these are relationships that you've had through, let's say, your private equity arm or through the hedge fund arm that you can then leverage on the VC side.
That's exactly right. So a great example is we were one of the early investors in Staples when we were doing early diligence on Kiva Systems, robotics company, which got acquired by Amazon. We were able to leverage the Bain Capital network to get to an executive who ran all of North American distribution for Staples, and he met with Mick, the founder of Kiva, on our behalf. He spent literally 4 hours with the company, and the next morning he called me up and said, "You'd be crazy not to invest. This is the most revolutionary technology I've ever seen, in my entire history in distribution." And I think for Mick, as an entrepreneur, he said, "Wow, Bain Capital with one phone call got me to the decision maker of the second largest e-commerce company in the world." So it's really being able to leverage those kinds of relationships. We're a large investor in Hospital Corporation of America, Toys R Us, Dunkin' Donuts, previously Warner Music. So across a whole range of industries, we're able to leverage our corporation and Fortune 500 contacts on behalf of early stage startups. It's extremely powerful.
That's very interesting. I mean, you have to think that even the smallest startup, some of those connections could definitely come in handy. You have a particular focus, you said, on e-commerce and B2B, so there are a lot of opportunities there.
That's right. And I think what you find is it's actually even more powerful the earlier stage you are. If you're a company that is already $50 million in revenue, you've got a huge sales force, you've got a great website, you've got a lot of proven customers, can we help, facilitate an introduction? Absolutely. But you don't really need that much help on that dimension. But if you're a brand new company, you don't have any customers yet, you may have some great technology, you don't have that lighthouse customer secured yet, no one knows you, you may not even have a website, that's where our ability to make a few phone calls, get you in front of a senior decision maker, and not only get you in front of them, but get you in front of them with the stamp of, hey, Bain Capital Ventures has vetted this company, we've made the decision to invest in this company, we're on the board of this company, that helps a lot. And so that for us is a huge part of our value add to entrepreneurs. Obviously, here in Silicon Valley, there's lots of capital, lots of venture firms.
I was talking to another VC, Ted Schlein. He was on this show a few weeks ago from Kleiner Perkins, and he's been in this industry for almost 20 years. And he said the biggest change is just there's this huge flux of capital.
That's right.
And it's really up to the entrepreneur to decide on where to get that capital from.
That's exactly right. And what we tell entrepreneurs is, look, you don't really need a venture firm's help with relationships inside Silicon Valley. If you're a good entrepreneur, you can get to anyone you want at Google or at Facebook or Twitter or Salesforce or Oracle because they're here in your backyard, and chances are anyone you want to get to is 1 or 2 degrees removed from you.
Right.
But if you want to get to executives, east of 101, Main Street, Wall Street, corporate America, Madison Avenue, that's where our network and our relationships are, I think, second to none. And so that really is our calling card. Now, obviously, we strive to do all the other things as well, be active board members, help with recruiting. We've got a great program that you guys have covered called Startup Academy, which helps with college recruiting on the technical side. A whole range of value-add services. But at the end of the day, if I had to boil it down to one thing we can do that I think very few other venture firms can do, it's really that access to businesses large and small across the globe.
I want to move on to another audience question from Jason. As an early stage bootstrap startup that has a product but is a ways off from growth mode, what's the best answer if an investor asks how much capital are you looking for? So basically, how do you determine, how much capital a startup needs at that early stage, whether or not you actually have the functioning product or not? Is it, are you taking into consideration the personal expenses of the entrepreneurs and early employees involved and revenue and things like that?
Great question. I think the highest level philosophy we have around capital is that the best startups in the world, the best businesses in the world, end up consuming very little capital. We firmly believe in, for entrepreneurs, be as capital efficient as you can. And obviously for the entrepreneur, that ultimately will mean less dilution when they build the company. But there are other benefits as well, which is, as the saying goes, necessity is the mother of invention. When you have very little capital and very little resources, you're forced to be scrappy, to be creative, to think out of the box, to do a lot with a little. And I think particularly during a phase of a startup where you haven't yet achieved product market fit, you don't have something yet that with high degree of confidence as an entrepreneur, hey, this is repeatable, it's scalable, I now have the formula down, I can just keep doing this over and over. Until you get to that phase, I think you want to spend as little money as you can. And the less you spend, the more time you can and runway you can buy yourself in order to keep experimenting and testing and iterating till you achieve that product market fit. Now, once you achieve product market fit and you've got a model that's scalable and you really feel like, if I put $1 into my machine, I know I can get $2 out, that's when you should go raise a lot of capital. And by the way, once you have that, investors and growth investors will be willing to give you that money at very high valuations, and so you won't have to be diluted. So raise as little as you can, as you have to. Try and buy yourself at least a couple years of runway. Iterate and keep your expenses low until you have product market fit, and then start stepping on the gas and scaling. And if you try and do it too early, and oftentimes because there's so much capital out there, entrepreneurs are able to raise a lot of money at those early stages. And if it's sitting in the bank, no matter how disciplined you are, the pressure is enormous to actually go spend it, before
Right.
you actually have gotten to the point where the model, is working and you have that proven formula.
So moving on into a similar question, Michael sent us a question. How do you feel about founders taking money off the table in later stage financings, Series B, C, that
Sure.
sort of area?
I think, first of all, every situation is case by case. And so I think with a lot of these questions, it's very hard to give a generic answer.
Right.
But, I think that, again, at the highest level, our fundamental view is it's all about alignment of incentives and alignment of interests. And I think in many cases, you have situations where both the entrepreneurs and the investors feel like this is an enormous opportunity. Rather than trying to sell now, let's keep playing on and let's keep building, because rather than selling for $300 or $400 million, we think we can build a billion or multi-billion-dollar company. Implicitly, all of us at that point are taking on more risk. The entrepreneurs are taking on more risk because they could have cashed out, and they are doubling down effectively. And the investors are taking risks because, again, anytime you make a decision to play on, you're, again, implicitly saying, I'm not selling and I'm not cashing out my equity at this stage. The benefit that investors have is obviously we're diversified. We have a number of portfolio companies. But for an entrepreneur, all their eggs are so to speak, in this one basket. And so we are very firm believers that it makes a lot of sense in those situations for the entrepreneur to be able to diversify a little bit. Now, you don't want to diversify too much, but I think to give the founders an opportunity to take some chips off the table, put some money away in the bank, and then really focus all their energy on making the remaining equity be worth as much as possible. I think that's very much an alignment of interests, and it makes sense for all the shareholders involved. So that's generally how we think about it. It gets more complex as you think about what's the right amount and how much of a particular round should go to secondary versus primary. Should the secondary go to just the founders or early employees? So there's a lot of complexity, a lot of implications involved. But again, I think the basic view that we have is we want our interests to be aligned. If anything that is good for the founders and is good for the shareholders and good for the company, we're going to be supportive of.
Great. Well, Ajay, thank you so much for joining us
Leena.
this week. And
this is great.
Thanks.